Hi, everyone. Thanks for showing up. My name is John Gettinger. I'm the SVP of Marketing for Aria Systems. We're one of the gold sponsors here at the event. And I have with me today is Bob Harden. And Bob most recently was the Global Director of Billing Solutions at Experian. And now recently took an early retirement package and is now set up in his own private consulting business, out doing consultant work for recurring revenue. Anybody who's transitioning and bringing in recurring revenue or looking to optimize their solutions. And we're going to spend a little bit of time today talking about recurring revenue and some of the challenges and advantages that that model brings on. So before we get started, how many people are in recurring revenue businesses today, have a recurring revenue business? Okay, and how many are thinking about one? You are?
Most of my business right now is on a project basis, and I'm looking to convert that into recurring revenue or add a recurring stream.
Okay, fantastic. Well, great. Well, then you're coming to the right place to talk about it. So let's get started. And I'm just going to spend a few minutes talking about what's going on in the marketplace in the world. Just a few slides ahead of that, just to do some context setting, and Bob's going to get up and talk a bit about Experian, what was going on there, what happened, and kind of the process they went through in terms of expanding into using recurring revenue to expand into some new markets, and then we'll take some questions. So, if you've been out there in the market today, you know that there is a lot of stuff happening with recurring revenue. It's a hot topic out there in the market. This woman's comments, I think, characterize a lot of what's going on out there. Is that businesses are looking at recurring revenue as a strategic driver, as a way to do new stuff in the market. And I collected some interesting facts, and I think one I love to tell people is that based on a recent Gartner report, 47% of U.S. businesses have either adopted or considering adopting a recurring revenue model. So it's a huge trend, and if you're not involved with it today, you probably will be, either in your next job or at the company you're working with. Another interesting stat I have is we did a research project last year, and we figured out about consumers spend about $900 a month on recurring revenue products and services today, and that's growing as a segment of their wallet. So it's definitely a trend that's not just a fad. It's something that's really we look at as a really tectonic shift in how consumers and businesses are buying products and services today. So a couple other things I picked up from a recent Gartner report. 35% of global 2,000 companies with non-media digital products, so that's not even software and entertainment products, are looking at will generate between 5 and 10% of their incremental revenue through subscription-based services. So I thought that was an interesting. And then of course, cloud billing, which is what Aria is part of, is a really fast-growing segment of that market. I think more and more companies are looking at cloud solutions as an alternative to on-premise for a variety of reasons, and we'll talk about that in a second. How many of you guys have cloud-based software as a service or cloud-based solutions in your business or using them there? Yeah, so almost everybody here. And are considering them? Any guys considering them? Or yeah, good. So yeah, so that's, I think, says a lot there. So why is that the case? Well, I've really break it down into five different, six different drivers that why is this happening in the market? Why are all these great stats and stuff? One is, of course, and we see this with a lot of our customers, Wall Street friendly. I think in a few cases we've had customers where literally the board has said, thou shalt, bring in a subscription business into your, convert some part of your business into subscription. We recently, closed a deal with a major software provider that had never had a subscription offering and came out of a board meeting, and suddenly the mandate came on a high. We want to move your business into subscription. So some cases it's coming in at the board level. I think some other drivers. One is market expansion. So and I think Bob will talk a little bit about this. Is using recurring revenue products to expand your market, get into the nooks and crannies of the markets that you aren't able to address. If you have a really expensive offering, that might cost millions of dollars, put it into a subscription and deliver that. We have one customer who's doing that with very expensive medical equipment, and they're using that, kind of a vending machine model to get into smaller hospitals and facilities where, they can't afford that $5 million, MRI purchase. So, market expansion, getting into new areas of the market, increasing lifetime value with your existing customers. So, I have a customer who's a sleep mattress company, right? And so and if anyone knows anything about the mattress business, you sell, how many mattresses does a consumer buy in a lifetime? 2 or 3, maybe. And so what they're doing is they're selling a mattress, and now they're selling a monitoring service to go with that mattress, a sleep monitoring service. So they can continue to increase the lifetime value of the customer, get more money out of the customer than you would otherwise be able to do, and use recurring revenue subscription or usage-based services to do that. I think, competitive differentiation, we saw that play out in spades with Netflix versus Blockbuster as a way to really differentiate and use subscriptions to position yourself very well against a competitor. In the case with Blockbuster, with devastating results, literally put them out of business within about a 10-year period. Innovation, I think, what we guys seen, Zipcars and Lyft and on some of these new sharing services, the sharing economy, where they're using subscriptions to actually offer new types of services. My favorite now is the Cocktail of the Month Club, where every month you get a little box with some stuff to mix together and create cocktails for your friends. So there's a lot of innovation that's going on around the subscription model and using that to create brand new products and services that don't exist today. And then finally, customer preference. I think, with the economy and where things are going from an economic standpoint, consumers are preferring businesses that actually offer things on subscription or usage-based. Why spend a bunch of money for something like a car if you only need it, a couple times a week? And why not share it and let other people use that resource too? So all these things are really contributing to what this massive shift that's going on in the economy around subscription products and services. So just a quick, when I say recurring revenue, a lot of people go right to the idea of subscriptions, and it's a bit more than that. And the way I like to think of it is that it's really a spectrum. So on one end, you've got pure subscriptions, and the best example I can give you of that is a magazine, right? You pay a subscription, a monthly subscription price, you get a magazine. It's more or less the same size and shape as the magazine you're going to get the following month, and you pay a monthly price for that. So that's a pure subscription model. On the other end, you have a pure consumption-based model, which might be like your electricity or your water, where you're just paying for exactly what you use, and it's metered out in a per kilowatt hour or per whatever cubic foot of water that you consume. You're just paying for exactly what you use. But there's also combinations, right? So there's and a good example of that is like the cell phone plan, where you have a subscription with a certain amount of usage attached to it, and an overage charge if you go over that, and then if you pay a higher subscription price, you get more usage and more different overage plan. And so anywhere along that spectrum, we see businesses, and then there's adding prepay, postpay. Do you invoice? Do you charge the credit card? Do you what are the terms on the contract? Are there penalties, fees? So there's a lot more complexity to this than simply charging that card every month, and which a lot of people, when they first think about subscription, they go, oh, well, I'll just run a credit payment every month for you. There's a bit more complexity to it than that. And so I think the complexity comes really in two different flavors. One is and especially from the finance standpoint, there's a whole new set of metrics and KPIs that you're gonna have to deal with when you move to a subscription business, a recurring revenue business. And you're not going to look at revenue anymore. You're going to look at monthly recurring revenue, and you're not going to look at customer loyalty. You're going to look at a customer abandonment and churn, because if you're trying to monetize that relationship over time, you want to know how many of those people are abandoning the renewal process, and how do we fix that? One of the big factors in recurring revenue businesses is you tend to pay a pretty big upfront cost to acquire that customer, with the idea that you're going to hang on to that customer for a while and make more money over time than you would have otherwise with a one-time purchase. That's basically the trade-off that you're making. It's just come on and join the company and join our business, and then we may pay $50 or $100 to acquire you, but we think over 2 or 3 years we'll make $2,000 or $3,000, and so that's the profit that you're going to make on that in that situation. So it creates a very different dynamic than a one-time purchase where you go, hey, here's the cost of the goods. Thank you very much. Here's your money. Goodbye. We all go on our separate way. In a recurring revenue business, you're taking a bit of a gamble, and so there's a risk there. But for businesses that have done it and managed this thing correctly, the payout's tremendous because you've got that customer relationship and you've got this opportunity to sell to. Which brings me up to my second dimension. So one, as I said previously, one change, and especially from a financial operations standpoint, is you've got a whole new set of metrics that you're going to interact with and new drivers for your business. I think what's often overlooked, and for those of you who are new in the business, you'll probably resonate with this, is that you also got really a different type of relationship with the customer than you have in a one-time purchase model. And for the reasons that I just said, you've got to hang on to that customer for a while to recoup the cost that you spent to acquire them. I think I heard somewhere that Netflix spends $45, $50 to acquire a customer. And so, if it's a $7.99 or whatever, $9.99 a month that they charge you, so you've got 4 or 5 months to pay that back initially, and before you even start making profit on it. And fortunately for Netflix, their sort of average retention is about 2 to 3 years. So it's a good bet for them. They make their costs back and then some. But I think the hard thing, especially for finance folks, is you've got this very different type of customer relationship. And because the customer can often walk away from the agreement before you've really realized all the profit in there, you really have to change the dynamics of the company. For many companies, you have to become much more customer-centric. And this is a trend that goes beyond just recurring revenue, but it is this idea of becoming more a customer-centric organization or more customer-friendly. We're trying to become more customer-focused. And what that really means is we're really trying to improve our ability to understand a customer and for the customer to interact with the company. And I think this is a key point, and something, of course, systems like Aria really have to produce is, for example, how do we share information with the customer? Customer wants to see their account balance. Well, how do we do that? We haven't really thought about that. Or when the customer calls into the customer service line, you want to have their account information, handy so that if a customer has a problem, the customer service rep says, oh yeah, I can see what's going on right here. I need to issue a credit. So those kind of experiences, which in a one-time purchase don't even exist, suddenly you have to start thinking about them in the organization and how do we make those happen? How do we make sure the CSR has all the information that they need when they need it? Or the salesperson, 3 months before the renewal on the contract comes up, we want the salesperson to have a tickler in their file to make sure, they call up the customer and go, hey, renewal's coming up. Is there anything we need to talk about? So change is really from a system standpoint, and that's, I think, one of the areas that's often overlooked in this. So what makes this hard is that what it makes challenging for organizations is that really billing in a recurring revenue world is a life cycle process. And it starts when you first acquire that customer and onboard them and get them into your business, and it continues all the way through to when you retire them out of you as a customer. And there's a number of discrete steps. We actually put together this capabilities model to kind of describe what the process typically looks like for an organization. So you've got the acquisition stage where you've got to, of course, sell them the products and services. You've got some kind of storefront maybe going on online. There's a CRM integration in place. You've got to be able to activate and notify them about services. There's an ongoing kind of tracking and responding. How much of the service are they using? Are there issues that are coming up? Do they need to communicate with you? Of course, the all-important calculating and billing, especially in a recurring revenue world. There's things like RevRec. How do you recognize revenue if someone's doing a usage-based plan? And how do you manage that? Or what happens if you're doing a global service like Experian was doing, where you've got different tax laws and different currencies and different payment methods going on? And then, of course, there's the reporting aspect of this, which, as I said, the bet that any company's making in a recurring revenue model is that we're going to make way more money over time than we would have otherwise made with a one-time purchase. So how do you optimize that offer, the pricing, versus the length of time that they stay on? If you're having abandonment rates, why are you having abandonment rates? So there's a lot more analyzation and reporting you need to look into to really make this happen. And as we like to say, it gets the water gets deep pretty quickly, because underneath these things there's a lot of other considerations. And that's where a system like an Aria can come in to help you automate all this stuff and make sure that it's getting handled properly. You don't have an army of people in here managing it. So that's it for my part, and I'm going to turn this over to Bob here, and he's going to tell you a little bit about some of this how this played out at Experian and what they and where they came from and where they got to today.
All right, thanks,
Bob.
John. So I think you know about Experian. Most of you are familiar with who Experian is, global information services company. I spent a good portion of my career actually with Experian, the last 15 years, working on revenue systems and billing. I've built or been involved in building a couple of recurring revenue systems from scratch, or recurring revenue billing systems, and have also been involved in implementing packages, in trying to get the big red box ERP package to do recurring revenue. That's why I've got this gray in my mustache and my hair. And most recently in deploying the software as a service solution from these guys over here. What you need to know about Experian for this conversation is that Experian has an aggressive growth program going on. And part of that aggressive growth program is expanding internationally. They're in 40 plus countries. And at the time, what Experian was looking at doing was expanding existing operations in some of the smaller and mid-sized markets, and in developing new operations in markets where they weren't currently doing business. So specifically, the project that I was called in to become a part of was the expansion and creation of a new credit bureau in Australia, which opened up in February of this year. But about a year and a half ago, that was just or a little over a year and a half now, that was kind of just a concept in people's minds. And a few of us were called together, finance, marketing, sales, and somebody like me from the IT side. I'm an IT guy. I'm not a finance guy, but as I'm sure you're seeing in your businesses, and I was an assembly language programmer when I started at Experian. I mean, I've written code on billing systems. I've managed the development of those systems. I've managed implementation of packages. And I think what you're seeing in your businesses now is probably a convergence of these IT and business functions. Your finance and marketing people are becoming more IT savvy. Your IT people are becoming more business savvy. And we're working much closer together. It's not just about building you a solution or writing the right code. It's about understanding how your business works. And that's what we wanted to do from the IT side that I was a part of. So we're called into this meeting and told that there's an exciting new opportunity. We're going to build a credit bureau in Australia. We're going to provide expansion opportunities in other markets outside the US on 3 different continents. And so as the IT guy who has to provide a billing solution to support this, I start asking questions. Things like, what products are we going to sell? What are the monetization models? What's going to be consumed? How often is it consumed? How repetitive is the consumption? Experian's primary business, selling credit reports, is a recurring revenue business. I mean, those systems I was working on years ago were recurring revenue systems. How are we going to charge customers for these products? How are we going to measure usage? How do we monetize this stuff? And oh yeah, as we're doing this, because the answers to those questions were, we'll get back to you. We'll let you know. Right now it's a concept more than a design. So we'll let you know, but we will need to support some existing businesses, especially in those markets where we're already doing business. So as the IT guy at this point, I'm scratching my head. What we did was we pulled together a cross-functional team, finance, IT, with some support from the sales and marketing side, and we brought in a third-party consultant because we knew what we knew about billing systems. We weren't quite sure what we didn't know, and we'd worked with about half a dozen vendors in the field, but we didn't know what was out there that we didn't know about. So we brought in a third party to help work with us, and we said, let's go find us a new billing system that'll support this business expansion. As we as we started to dig into this process, and the first thing you do from the IT side is try to understand what the requirements are. What does the business need? Well, what we saw was that those needs were really going to be fleshed out over time. So we took a little bit different approach, and we looked at what would a generic solution look like that would support a lot of different business models, and what are the challenges that we need to address from the business side to make this successful. So the first couple up there are things that you're all concerned with, and they actually kind of interlock. It's the low cost to serve and the rapid time to market. And from a cost to serve perspective, we realized pretty quickly that we needed to look at a couple of different aspects of that. One's the startup investment. A business that has an annual turnover of $5 to $10 million a year can't afford a $10 million Oracle BRM billing project. So we needed to look at how do we provide a low startup cost, how do we minimize the ongoing IT costs and provide some degree of cost certainty to the business. And again, in the type of business that we were looking at, the information services business, the revenue curve for a startup is kind of like a hockey stick. It goes very flat for a long period of time and then suddenly shoots like that. Well, for that flat period of time, we needed to provide a very low cost to serve, and both from the IT side and from the business side. So we needed low touch processes. In a business in a small country like Denmark in Europe, where we put a different kind of solution a few years ago, there's basically a couple of people running the entire billing AR operation, and we needed to be able to provide a solution that wouldn't force them to spend hours of time setting up, maintaining customers, setting up new price plans, and pulling in the guys from IT every time they wanted to put a new product into the system. So rapid time to market, if you've talked to billing providers, if you've been through billing projects, the industry standard is 12 to 18 months. If you go buy a box of software from Oracle or from Amdocs or one of the big vendors, you're looking at probably an 18-month deployment, and they'll tell you 9 to 12, but when they scope it out, you're looking at more like 18. Some of the smaller providers, you might be looking at a 9 to 12-month process. Well, that was too long for us. We wanted to be able to accelerate the ramp up. And we knew the first project would take a while. But once we had the first project in, we wanted to be able to ramp things up quickly on future expansions. We also wanted to be able to add additional products and services without involving the IT guys, and really to allow the business to do that in minutes or hours instead of days or weeks. Experian also wanted to reach some unserved or underserved market segments. As a business, there were certain types of customers we were good at reaching, others we were not so good at. We also wanted to integrate with existing systems. Experian has and has been showcased at Oracle Open World the last couple of years for one of the first release 12.0 ERP global implementation, single global instance, single global chart of accounts. We needed to integrate with that system. We also needed to integrate with the CRM systems. What we wanted to provide, especially to the B2B part of the business, was a complete stream from prospect to cash. So that from CRM integrated with billing, that billing integrated with AR and financial systems. We also wanted to make sure that we didn't leave money on the table, and that's one of the challenges that you have with a subscription type of model is right-sizing those subscriptions. And actually one of the reasons for going with a usage model rather than a subscription is because you can tie your revenues much closer to your costs. And in the type of business that Experian was in, where one customer buys 100 units a month and another customer buys 1,000 units a month, having those two customers on the same subscription plan doesn't work. And depending on what business you're in, if you're delivering the same product every customer every month, a silver, gold, platinum type of subscription offering probably works for you. If you're not, and if you have variable costs based on the number of widgets that you're delivering or the number of the number of reports that you're delivering, then usage might be a better option. So we were very concerned about right pricing for subscriptions and usage. We were also concerned about providing flexibility to do upsell, cross-sell, and really to maximize the customer value over the lifetime with the customer. We didn't want to make individual sales. As a business, what Experian was really looking at doing was stretching out that customer life cycle and retaining those customers longer. It's expensive to obtain customers, and so if the longer you keep them, the better off you are. So in order to facilitate that, one of the things that we wanted to provide, and we're very interested in providing, was some foot-in-the-door types of opportunities for customers that you can do in a recurring revenue. They do it in retail, it's a loss leader. For us, it's the foot in the door, the freemium, the premium, come on board, try us for 30 days. If you like what you see, then this pricing kicks in. We did a pretty exhaustive search, and again, we had our third-party vendor pre-screen for us about 25 different billing solutions, and those range from the top tier 1 players like Oracle and Amdocs and Convergys, those guys that are focused on primarily on telco, because our business wasn't that different in terms of the way we put invoices out from what telcos do. So we started there and we looked at those businesses, and then we went down through some tier 2 players, through some tier 3 players, and one of the things we asked our provider to do was pre-screen for us some software as a service vendors. And as it turns out, after first shortlisting down to a couple of software vendors and a SaaS vendor, and we were actually surprised that a SaaS vendor made the cut because we didn't think the market was mature enough a year and a half, 2 years ago. We didn't think any of the products were that mature. But we kept trying to eliminate the SaaS vendor as we worked through some fairly detailed use cases, thinking there's no way these guys can do this, and they came back showing us again and again, showing us how they could do it. We wound up dropping the more expensive options and going with a cloud-based billing solution. And actually we have, from prospect to cash, everything in front of our Oracle ERP system is now in the cloud. So we're in CRM in the cloud, billing in the cloud. We used a cloud-based integration tool, Dell Boomi, to link up the CRM system and the billing system. We use the Aria billing platform. We're managing our client provisioning through a workflow that's set up by setting up a B2B customer in the CRM platform, marking that customer as sold when the contract is signed. The data is populated into billing, and billing is managing the provisioning through the software systems that deliver the information products out to our customers, using standard out-of-the-box functionality that's available in the billing solution. We integrated with our Oracle ERP platform. That was a little more complicated than the CRM integration. We had this global platform used in all of our businesses. We also had some fairly standard for us integration. We were able to tap into some reporting functions that were available within the billing platform. And over time, I think one of the areas where you'll see all of the vendors in this field develop is in their ability to integrate with the ERP platforms. I think that'll be standard out-of-the-box API functionality. And right now it is on the GL side, but not on the receivable side. I think you'll see that on the receivable side within the next year or two. For the business, we wanted to provide recurring revenue models wherever possible. And one of the things, and it was on one of John's slides, that we locked into was the ability to do long-term subscriptions and subscriptions with overages. So the best of both worlds, subscription where you put a limit on usage, like your phone bill. Your 900 minutes, and if you use 910 minutes, you pay for the extra 10 minutes on a per unit basis. We have some very similar pricing setups that we made available to the business. I can't tell you specifically what Experian's doing in Australia or in other markets, but I can tell you we provided that capability. We also provided straight usage capability. We provided some simple order management functionality because some of the products that Experian sells are one-time sales. We provided prepaid, and I tell you, if you can get on a prepaid relationship with your customers, it goes back to those low-touch processes and reducing the headcount in your back office. And then flexibility, and one that's not on here is scalability. Actually, that's on another slide. But flexibility to provide a variety of offerings to the customers was pretty critical, and it's something we were able to provide with the solution that we deployed. Benefits of a cloud-based solution. Half of you raised your hands that you're already in the cloud for something, so you're fairly familiar with these. I'm not sure how much I liked the first one because I was the IT guy. So I liked it and I didn't like it. You know what? We did a billing project and I didn't have to put in any servers. I didn't have to buy any Oracle database software. I didn't have to buy Linux. I didn't have to buy storage. I didn't have to do any of that. We eliminated that upfront hardware software deployment cost. We provided predictable ongoing costs. Again, on the finance side, they're smiling about that. We provided low-touch processes to the business. We were able to provide those kinds of cost benefits. From an IT perspective, and actually, I mean, this touches you guys here, we were able to share the technology risk with the vendor. So when Oracle decides that release 10 point whatever of the operating system is going to fall out of support, or the database is going to fall out of support, I don't have to go to you anymore and ask for $100,000 to do an Oracle upgrade that wasn't budgeted. The vendor handles that. That's a vendor risk. And we're keeping an eye on our vendor and watching their technology changes and making sure that they were keeping up with what our Oracle contacts were telling us happened in the market because they're on an Oracle database. And the vendor takes that risk. Same with the scalability down in the bottom. It's the vendor that has to scale. If their customers increase in volume, it's the vendor that has to bring that new server on or bring the new set of servers on. So we were able to improve time to market. The initial ramp up, our initial project ran probably 15 months. And that was more a technology issue on our product delivery side than anything related to our vendor. We stopped and started several times on the billing project, waiting for the product delivery folks to catch up with us. But as we were looking at future products or projects to deploy, we were looking at timelines that we were measuring in weeks instead of months, which is huge. The other thing is new products, services, price plans. IT doesn't need to be involved in those. There's no IT involvement. Those can be set up directly by the back office users. It's a repeatable solution. The project that we deployed out in Australia will be deployed in other markets. Probably 80 to 90%, depending on the idiosyncrasies of the market. There's some markets in Europe where there are some very interesting requirements around what has to be on an invoice or what an invoice has to look like. The same in Latin America. And so it's not 100% move from one to another, but it's probably 80 to 90%. And the changes are not critical with the exception of tax, which is just individualized to just about every market you go into. One of the things we do at the end of projects, and I've had an opportunity to do it now on several billing projects, also to look at white papers and presentations from other people who've done the same things I have, is to take a look to do an after action assessment. Lessons learned. What did we learn? And so combined on this slide are the lessons from several projects I've been involved in and case studies I've been able to hear at conferences like this one. And you'll notice there's 5 points here. it just dawned on me, and look at this slide again today, that 4 of those points really don't have anything to do with technology. What you're talking about here is a business transformation. It's not just a system deployment. And so to transform billing, to transform from one-time sales to recurring sales, starts with a business strategy. You need a business. It needs to be driven by the business. Don't let your IT guys drive this, because we'll go out and buy the most expensive, most sexy toys that we can find to play with. It's the kind of guys we are. I think back to my days as an assembler programmer, and if you don't know what that is, think Big Bang Theory without the PhDs in physics. We were those kinds of guys, and some of us, luckily some of us grew out of that, but it's strategy first, not systems. Systems are there to help you implement a business strategy. You don't build a business strategy because your CIO or your IT guy wants to implement this system. So it's systems first with executive buy-in. You guys are the ones that need to be driving this. You and with the support of your CEOs. And part of that business strategy has to be to improve your client experience, a client-centric approach. John touched on it in his presentation, that really you're talking about building lifetime relationships now with your customers. And to do that, you've got to be easy to do business with. I mean, I've had a personal experience where I actually walked away from a cell phone provider because I couldn't tell from month to month what they were charging me for. And this was several years ago, and they've improved what they do now because I probably wasn't the only one. But again, back to managing those costs, having a low-touch processes in your back offices, one of the things you don't want is for your customers to be calling you up and asking, what the heck is on my invoice? What are you charging me for? You charged me the wrong amount. You want to make it easier for your clients to do business with you, and that client-centric approach needs to be a part of that business strategy. Then you need enforceable standards, and enforceable from the C-level suite. One of the best implemented billing projects I've ever seen is a global bank, and they're headquartered here in New York. They're implementing one of Oracle's products in a business that spans 64 different geographical regions, 64 different countries. And they're doing it 1 or 2 or 3 countries at a time. But part of their implementation strategy, and part of the reason they've been so successful, is at the start of that project, they agreed globally on a set of standards. And they got executive buy-in to support that. And as a result, they basically have a box that they go from country to country to country with, or from business unit to business unit to business unit with. And if you really need a change, you can get it. But you need to go before an executive committee, a C-level committee, to get that exception. Now comes the technology part. Now that you've got the strategy, hopefully a client-centered strategy, some standards and processes defined, what's the out-of-the-box technology that'll work for that? Eliminate the C word. For IT guys, the C word is customization. And if we're working with packages, we really don't want to customize them, because customization introduces risks into your business. So you have a package like Sage, and you decide you need to make a customization to it, and then Sage comes along with the next newest and greatest version, and guess what? Your customization is not compatible anymore. So we want to eliminate the C word. We want to use out-of-the-box technology as much as possible. And if there's something that your solution won't do, something in these processes that your solution won't support, you might want to take a look at why that is, because there's a lot of other businesses out there that have processes that solution will support. What's different about yours, and does it really need to be different? Finally, you need to be able to measure success. And you need to have KPIs defined that will allow you to measure success. Again, great case study, not a project that I was on, a telco in Asia that decided they were too difficult to do business with. They had 4,500 tariff plans, and they realized that about 85 to 90% of their revenue was coming off 150 of those plans. The customers that weren't on those plans couldn't figure out what they were being charged. CEO said, I want to be easier to do business with. And you know what? Every division manager is going to be measured as we do this project on whether or not we become easier to do business with. And so one of the KPIs that you're going to be measured on is what you do this year in terms of reducing the number of tariff plans that your division's offering and making your pricing easier for your customers to understand. So on the project that I just told you about with Experian, we didn't do that great a job with the strategy first. The strategy evolved as we were developing the project. Guess what? It cost us money. It cost us time and money because we didn't have the strategy well enough to find. Now, part of that was a business risk that we accepted at the start of the project, and that's what happened. We did a pretty good job of trying to make it easier to do business with Experian, and we did okay there. Enforceable standards, executive buy-in, it was C+ on that one. And again, it cost us money. If you don't do these things, it's going to cost you money. Out-of-the-box technology, we actually have a pretty good story on that because we went to our vendor with a customization that we wanted them to make in their system related to something that would happen to a client's data and notifications that would come out related to hitting prepaid thresholds. And we thought we were one of their strategic customers. And we went and asked for this customization, and they said, no, not going to do it. But what they did then was show us how to use the out-of-the-box technology to get pretty much the same thing, and how to use a combination of the programming interfaces, the APIs that were available in Aria, and our Dell Boomi integration tool to make the same data change that we wanted their system to make. So no customization, those APIs are going to be there. The same APIs will be there 10 versions from now. And so we don't have to worry about this specific piece of code that we needed at some point not being supported. So we did a pretty good job of that. We're still working on the KPIs and still working on analytics, because one of the things you need to look at if you go in this route, and some of you have already experienced this, you're looking at a new set of success metrics. You're looking at different metrics. You're looking at how efficient your customer relationship is, rather than just what your revenues are. And that's something they're still working on. That was something that was still in the box when I left Experian. So with that, I want to turn it back over to John and let him wrap up.
Great, thanks, Bob. So just a couple last words here, and then we'll take some questions. If you're in the market for shopping for a solution, so you've heard about Bob, one of our customers at Aria, and what they achieved, and I would say that anybody who's really going to do this, you probably should look at some automation. I think doing this on spreadsheets would be next to impossible, except if you're a really small business. But once you get to any size, I think the systems are the only way to deal with this. And so I'll leave you with a few thoughts about what to look for in terms of solutions. So I think, and Bob alluded to this, you want something that's going to let you get into the market quickly. And that touches a couple different capabilities. How accessible is the product catalog, the account system to business people versus IT people? How much do you have to have IT involved in any solution? I think that's a key area, and especially to me, a lot of what recurring revenue is about. It's kind of a brave new world for a lot of companies, and it's an opportunity to really expand your market and do a lot of great things. But it also introduces a lot of challenges, and so there's going to be experimentation in your business. Your product people and your business people are going to want to change things up. You heard some of these ideas in Bob's talk about, we figured out that we needed to, limit subscription, right? How much people could consume during subscription. And we've seen this quite a bit. Companies start out with subscriptions and they realize, there's a usage component to this and we need to change some things over. So take a good look around how does the technology support that, and how easy or hard is it to make changes in the solution? I think that's a key area that's often overlooked. Is many times these big implementation costs, you nail everything down, and someone comes up with a bright idea, and you go back to your provider, and it's like, yeah, that's basically a re-implementation. That's going to cost you. And so I think one key area is that flexibility around the technology. The other thing is we've heard also is that, Bob said it great, I'm going to actually steal that, is you're creating a lifetime relationship with this customer. You're not just selling them a widget and, hey, we'll see you next time. You're now really entering into a very different kind of relationship in a recurring revenue business. And that's different from a cultural standpoint. It's also different from a business automation and a business system standpoint. So look to see what any product that you're going to buy, how does it help you support that relationship? I think that's a critical area. And I gave you a couple examples, of the ability to share account information with the customer, that and the ability to keep systems synchronized so that when the customer calls into client services or they show up in sales somewhere, that people in the organization have access to that information. Today, a lot of financial information, a lot of that's in the financial ops systems, but getting it into these other systems is a challenge, as I'm sure you guys know. So looking at where the capabilities are and how does that allow you to share information throughout the organization so that you can keep everyone focused on the customer, everyone has the same view of the customer. And then finally, what insight does the technology give you in terms of understanding customer behavior? If you're going to lifetime value, over time you're going to want to optimize that value. Are we charging enough? What happens if we raise the price 20%? How many people are we going to lose? Looking at what analytics and what reporting gives you to be able to answer some of those questions, because those will come up. You will get, someone will go, hey, you know what, I feel like we're not charging enough here, or, it looks like we're not making enough money, let's raise the price 20%. You need to be able to come back and figure out, is that a good idea or not a good idea? And once again, in a one-time purchase system, that's not as big a deal, but in recurring revenue, those are the kind of things that are going to come up, and those are I think the key capability areas you need to look at, in addition to being able to do billing and payment handling and invoicing, all the normal stuff that you would expect. So that's it on our side. I guess we've got a few minutes here. We can take some questions, if there are any. Anybody? Late afternoon here. Were you looking for cocktails? Cocktail of the Month Club? Well, if there's no questions, then and you guys want to come by and check out Aria, Phil and Chris will be at the booth for the next couple hours, and happy to talk to you any further if you've got any questions. Yep. Okay. Great. Thank you.
All right. Thank you.